Good afternoon. Thank you for joining us. Today, in our panel, we will be covering due diligence as a pillar of the investment process. We have Neil Thakur, and
Hi.
go ahead.
Good morning. Go ahead, sorry.
And Wyatt Lonergan.
Hello, again.
Hello, guys. And to give a little bio about our speakers today, Neil is the managing director and co-founder of Teknos Associate. Teknos Associate is a valuation advisory firm specializing in Web3 investments, particularly assessing liquidity, token valuation, and complex securities. Logan, as you guys have met earlier, he is a general partner at VanEck Ventures. VanEck is a global asset manager with over $130 billion AUM, and he is the GP of the venture firm, which the fund is closed a $40 million round.
Yep.
Perfect. And to introduce myself, my name is Teresa Liang. I am an ex-investment banker and operator turned early-stage investor. I am an investor at Decasonic. Decasonic is an early-stage VC fund where we invest in the intersection of AI and blockchain technologies. We cover pre-seed up to Series A, B, average check sizes between $1 to $3 million. The fund is structured into two sides. We have our venture deals and then our liquid tokens, and I cover a lot of our venture deals. So excited to delve into this topic. So Neil, Wyatt, tell me what are the trends that you guys are seeing in the market?
Sure, I'll start. I'd say one of the coolest trends we're seeing is just like a lot of, I hear sometimes like people get jaded about like talent in crypto, and I actually would disagree. I think some great talent is coming into crypto. People saw, for example, we had a founder who was a VP at Citi. He was at Citibank for over 20 years. I was a VP there, and the day after Trump got elected, he put in his 2-week notice and dropped a white paper, and we funded him like a couple months ago. Seeing the same thing from companies like OpenAI, for example, talent's leaving, and they're understanding that there are some really unique problems that blockchains can solve, and they want, they see that the government now and all the regulators are on board with this technology, and it's going to be integrated into society. And so they want to move early and be first movers. Seeing the same thing in kind of the broader fintech space as well. People are leaving companies, whether it be stablecoin issuers or platforms like Robinhood or Stripe or Visa, to come build new products because, they believe in this technology and they see, this new frontier that they can go, this land grab opportunity. So I actually think like now, I've been investing in crypto since 2021. And I've never been more excited about the talent pool. So that's probably the biggest trend I'm noticing.
Yeah, I mean, I would second all that. I think just obviously with the regulatory changes that we've seen over the last, week has certainly kind of taken the top off of kind of the market in different ways. Obviously, I think from an M&A standpoint, we're seeing more transactions than we ever have, your exchanges, wallets, et cetera. And then on the investment side, everything from, it was just talked about now, digital asset and treasury strategies and things of that manner. But on the venture side in of itself, we're seeing a lot of investments in just in general, like the DeFi space has just kicked off, right? Everything is focused on that right now. And just with the opportunities that we're seeing around stablecoins and related assets, expect that to continue.
Awesome, great. So this question's for Neil. What do you think the differences are in valuation between traditional securities and token complex securities?
It's a little bit of a loaded question there, but it just kind of, it depends on the situation, right? So I think if we're looking from like an M&A play and you're buying an asset or a project or a company that has a significant level of, call it its own treasury of tokens, right? Its own like native token. That's probably the biggest difference that we're seeing versus like, buying something that's more infrastructure related, which almost follows like almost like traditional business patterns in terms of revenue at some level. But if you're going to buy a Web3 company with its native token or its own kind of digital asset strategy, it's not traditional P&L financials that we're looking at. It's about like this network effect and how it fits into its overall kind of ecosystem and how it's partnered with different strategies. And so we're looking at things in terms of, whether the expectations of, the token over the long term, how it's going to be utilized in the broader network. Are there staking mechanisms? All those sorts of things that we all come from a lot of the TradFi world, right? Where, we have three-statement financials and we understand how to build that model, and that's kind of turned upside down in this current environment. And so you digging into the native token and how it operates in that respect is really challenging, right? And saying like, I can predict the price of an asset that's not even traded yet, right, into the future, and how it's going to be utilized in the market can be challenging. So that is probably one of the biggest fundamental issues that we have when we're looking at acquisitions in that space.
Yeah, absolutely. I agree on the network effect as a signal, as evaluation method. So absolutely. And Wyatt, would love to learn about your approach in the due diligence process for early stage Web3 companies, Web3 and AI or Web3.
Yeah. I mean, in the first couple rounds of financing, you generally have very few data points, meaning that you don't have financials. Tech is usually being developed. To me, that's where I think it comes down to like the human connection you have, their communication ability to just, very clearly and concisely draw out what the business is trying to do, why they're the right people to go solve for it, and why now is the right time. And so I find it more of a kind of a connection thing in that you get very excited, they get very excited, and you're the right people to partner together. I think as like venture capital has exploded, capital is a commodity, and therefore like as we invest, we try to think of like certain theses and areas where we're hunting. But you always want to meet entrepreneurs who can inform and take that thesis to another level, just things you didn't even think about, for example. But, I think I heard something this morning from like Peter Fenton on this. It's like there's just this intuition where you're listening to a story and you're like, okay, I know. But in part of that, like the story that they're communicating, there's always things that like you don't hear. And usually those are kind of the boxes where I start to realize that this isn't, I'm maybe not the right person or, to be investing in this, or, this founder needs to spend more time kind of figuring out the business. For example, it could be someone's valuation request is completely disconnected from the underlying business because they haven't really thought about how the business scales yet, right? It's just, I have this idea, I'm building this technology, I want to bring it to market, and some of those things can just be little flags along the way that start to kind of break down the thesis. And so I love like when founders, for example, write a memo, because I think other than speaking, when you can read something, it really shows how well they've thought about the problem. And I think in crypto a lot as well, someone will see a good idea and try to like copy it and put some minor spin on it. If you really take time to write down the problem statement and why this is such a big market and why you're the right people to solve it and why now is the right time, you might find yourself kind of getting stumbled and needing to go back and really think about that problem statement a little bit further. And so I love when someone sends us like a deck and they also send us a memo, like a Notion page or something, because when you read long form content, you can pick up on like, wow, this person's really thought about X, Y, Z, or how the business model might evolve, or really considered like they're raising $2 million, but they're going to spend it on this, make sure they have enough runway. Like we might need to finance the company again in 12 to 18 months. Like it sounds really like there's a lot there, but like that's the point is I don't think you should fundraise until you've really, really thought about everything. Like what does your business look like in 2 years? Assuming all goes well and assuming all goes wrong. Because you need to leave this room to pivot, especially in your early stage. Like you can't just be plowing down the same path if it's not working. And so we generally try to back people that are kind of hunting in a specific area, knowing that there's like a very high probability that the business or even the core product itself pivots in some direction. And if you look at like most of the successful exits in like venture history, for example, I think some staggering number of them are actually pivots. So you have to bake that in. Like, am I willing to back this founder knowing that the business that we might eventually exit one day is not the business I'm being pitched today?
Absolutely, completely agree on. And to touch upon that, in my process of doing due diligence on early stage investments, definitely on founder market fit, and then I look at product market fit, narrative, and execution. And in terms of product market fit, I mean, it's such a broad term, and so I want to dive a little bit deeper on that. And the way I think about product market fit, especially early stage, you're right, it's more of an art than a science. And it's not just pure number-based like you would see with growth in late-stage companies. So when it's early stage, and our team really came up with metrics to look at CAC and LTV, so customer acquisition costs, and the lifetime value of your customer. Because these are going to be sustainable of what are your unit economics, how are you going to make money, can you make money, and what are the types of revenue streams. Even if it's not profitable now, can it have a path to profitability or a vision to profitability? So completely agree on that. So going back to Neil, our valuation expert here, can you tell me more about how you factor in the utility? How do you factor in the utility of the token in the valuation model?
Yeah, so that is the fundamental kind of core, I think, of a lot of the Web3 projects that we see. And when you look at the native token in of itself and how that factors in the overall business, it just kind of depends on what and we're getting back to product market fit and like what the use case is for the token in of itself and what the company's underlyingly doing. And if that token is used as a form of either payment, or if it's used as a form of like a governance token, how does that fit into the overall eco kind of strategy of the whole thing? Ultimately, and this will get into like what liquidity looks like for or an exit, right, for a lot of these companies. It kind of goes down that path, right? Are we building something where ultimately this token is utilized in an overall network for a certain type of industry, or is it something that is kind of complementary to something that's being built out? But ultimately, like if I'm looking at maybe either acquiring this company, and I look at like how the liquidity of the token's working, if just to be frank, outside of the top maybe 5 to 10 tokens, the liquidity of most of the altcoins out there, I mean, are varied significantly, right? And so if we look at like the depth of the order books and the markets, all that, and how those tokens have performed, they haven't been all that great, right, over the last few years. And so I think we're going to see that change over time after this frothiness is kind of focused in on like the top tokens and Bitcoin and all of that. And then once that market kind of changes over time, we're going to see that grow. And then I think with liquidity and valuation associated with, call it the altcoins of the market, that's going to drive value ultimately over time as we feel like that we're getting better use cases around the tokens in the Web3 market. So.
Awesome. And to preface to the audience of why I'm asking token valuation questions is, unlike traditional companies, with Web3 companies, oftentimes the term sheet includes safe plus token warrants, and so it's not just simply safe anymore, so packing in that token valuation as well. So thank you.
Hopefully that changes, though. I think with the Clarity Act, we won't have to, maybe we will, but like you should just be able to sell a token if you want. But I do think that people will realize most of these things, like they're tokens, but they're probably going to be tokenized securities, and I think that's okay. So as long as we make that a really easy path, because there's a great presentation from Thakur Research on like how tokens have a lemon problem, which means that they're just like there's nothing there. And I think certainly crypto is like the intersection of like the attention economy and technology and all these things, but like, call me crazy, like we celebrate as an industry when someone has product market fit by like people actually using it or real businesses using it.
Right.
And like the end state for me is that, you want to eventually, businesses need to plug into these things. Consumers need to plug into these things. Can't keep the lights on forever if you just are like, you have utility. You probably need to have things like revenue to continue development. And ideally, like, again, whether it's a network token, because not everything's a network, and that's okay, that we create a path such that companies who can build applications and want to use the benefits of tokens can do so, but have it be a security, and that's okay. They can do new things that they haven't traditionally been able to do. Because if you try to do it with equity today, it's like near impossible. And so there's certain regulatory building blocks that hopefully this administration will chop down, which means you can broadly distribute equity in a new way.
Right, because the tokens themselves at this point do not have a claim to the cap table, right?
No, and you have businesses that raise like equity and then they issue this like meaningless token, and both can do well. And I think they're at odds with each other, and we created this problem. The regulators created the problem. But I think now with this kind of new sandbox that's being proposed by Hester Pierce and the SEC, there should be a path to actually creating things that generate value. And again, there are certain network tokens I think that make sense, but it's not that everything has to just like be a payment token, for example, or just have quote utility. So hopefully we're trending in the right direction there.
Yeah, absolutely. And I guess to kind of talk a little bit more about the private venture side, and we all have background from TradFi and now, to Web3 industries. I think, tell me more about, I guess, the sourcing process and I guess the whole investment cycle, Wyatt. And I guess I'm happy to share a little bit more about how we do it at Decasonic. We actually built out our own AI agents. We have about 80 AI agents that we use for sourcing, and I definitely leverage that. So one agent that I love to use a lot is our thesis compatibility score. So every quarter, we come together as a team, write down our thesis, what we're seeing in the market signals. We use AI to help us to be able to scrape this data, scrape this information, along from taking signals from other open source models and closed source models, to be able to, when we get decks in, and we source about 300 startups, 300 leads a week, which is crazy, but AI really helps us with that. And so my favorite one is our AI agent, where we help with thesis compatibility score. So we get a deck, we load it in, and they scrape and kind of scan it with kind of our thesis for the quarter and gives us a score. But of course, it's not to replace us, it's to amplify and to give us little checkpoints as we do deeper dive into our due diligence. So that's our process using AI. But tell me more about your process, Wyatt.
It's pretty cool. My process involves. I heard someone call their coworker human coworker, so I'm gonna use that term. My human coworker, or my human partner Juan. No, we're kind of old school. I guess we Juan and I started investing at Circle together, kind of in the USDC ecosystem 4 years ago, and so we take more of like a craftsman approach. There's just two of us. We really leverage kind of VanEck for really all the back end, and we take more of a concentrated portfolio, a concentrated approach. And so our thesis has always been kind of like fintech on crypto rails, which gets into like payments, tokenized assets, like digital commodities, DeFi, lots of things like that. And so we take kind of more of a narrow focus, meaning that there are a bunch of funds that we've co-invested with over the years that are focused on that area. And we take more of like a reputation, I think, focused, or more of like a reputation-based approach, meaning that like we use founders in our network. And by the way, I think the cool part about venture is there's like so many ways to do the job. So that's fascinating. You guys use all this AI stuff. Yeah, we're just we're offline.
We can chat about this later.
Yeah, no, I think it's super cool. But we use a lot of founders, investors. And then what we do always is we publish our theses, which the VanEck intern, our Twitter account, posts. And what that does is it just kind of shows like, hey, this is kind of I would say it's not a niche, but a smaller area of the market that we are just laser focused on. If you want to work with us, we think about this stuff all the time, and we're happy to be kind of your partners along the way. Now, what that does is it attracts kind of the right people that we're looking for. As we expand and become more generalist over time, this is our first fund at VanEck, so eventually we'll be able to scale out and be more broad. But I love studying venture and the history of it, and I figured it was like, let's just be like super focused and kind of small to start.
Yeah, absolutely. I want to ask one more follow-up question to Wyatt, and then we'll get to Neil with 2 questions. So Wyatt, you talk a lot about fintech on crypto rails, and this is something I'm really bullish about and I love covering as well. So I want to know how or what metrics are you using to assess companies that are building fintech on crypto rails?
Well, so we had a portfolio of about like 80 plus companies at Circle, and so there's a kind of a depth of, I think, experience there that we get to use and benchmark. But again, like the early stage, it's what insights does this founder have that enables them to go build something truly meaningful and new that already isn't out there. That usually is based on some point in time, whether it be stablecoins coming to market. There are some teams that we followed for years at Circle, like one that we backed last year called Denari. They were building for 3 years in tokenized equities, but no one cared about it. And so I think it comes back to like we use really first and foremost the thesis that we have. We go hunt in those areas, and then you just found the right people who have really just, again, they think about the problem, because we don't have many metrics when we cut that check. At one point, again, we'll grow the fund and we'll be able to look at companies and have like a dearth of metrics and financials and things like that. But it's more that we think about, we ask a lot of questions, and can they go become that founder? Do they understand how to develop a sustainable business model? Can they sell? Where are their weaknesses? Where are their blind spots? Can they go recruit and build a team? Can they go become a CEO? I've talked about this many times, but I just think we're in the stage of like the commercialization of this technology. And so, it's not enough anymore to just put out a white paper and research. You have to go push that product, because everybody else this is a highly venture-backed category at this point. And so if you don't do it, someone's going to go raise a bunch of money, hire a bunch of BD and salespeople, and go beat you to it. And so I think there's a certain type of founder profile that we look for. And I think you get that over time by investing in the right people, investing in the wrong people. And it just comes down to like, what are the questions that we ask, and are we asking the right questions?
Yeah, absolutely. Neil, I guess a question I have for you is, how do you foresee the pathway to liquidity with the rise of Web3 companies? Do you think it's going to be more traditional M&As, IPO, or token liquidity, or anything else?
Yeah, I mean, we touched on a little bit of that in some of the prior questionings. It's a little bit varied. I think there was a point when we saw a lot of the altcoins kind of moving in a certain direction, where like all of a sudden this asset class represented like liquidity in a different way, where the venture world with the safe and token warrant that we're talking about, which has been around for a while, is that people would invest in the equity, but they really cared about the token. And you had these insane kind of, just pops in this token, right, for various numbers of altcoins. And so all of a sudden, now if I'm a venture player, I'm getting liquidity back very quickly, right, on that token. My lockups are a little bit lower, and I can realize those gains sooner. And so all of a sudden, it's not necessarily selling the company that provides that liquidity, it's the token in of itself. I feel like we're going to continue to see that come back a bit, but to your point, I mean, if we start selling tokens directly and we start kind of fusing the world of equities and securities, we start bringing ourselves back to almost traditional like IPOs and M&A exits, where the company itself has the network value in of itself. So I think we're going to see that transform over time, but it will take a little bit of time before we see that. But certainly the combination of liquidity, where the token represents value, is certainly here to stay for a while. But then the M&A world in of itself, with other types of projects that are similar to or sitting on like the picks and shovels of the world in the digital asset space, I think you're going to still, those are like traditional business models that have a token component, but I think you're going to see M&A there. And then the SPACs of the world that continue. I feel like I've been around for a while in this world, and we've seen those kind of go in and out of favor, but just with the digital asset strategies on the treasury side, it feels like those are back as well. So we could see IPOs make a move, which obviously we've seen a number come back now. So that probably doesn't answer the question directly. It's like all three are kind of in play at this point.
Yeah, absolutely. It's definitely situational. And I guess to close it out on due diligence as a pillar investment, I want to talk a little bit more about at Decasonic. So with frontier technology, there's going to be new ways of evaluating, the durability of the company. Physical products, usually it was point of sales, or with Web2 software, you have daily active users, monthly active users, ARR, MR, et cetera. And with Web3, I think all three of us touched upon network effect as being a strong indicator and signal, and like, what does that mean? What are these indicators? And I actually wrote a piece about this, about how I really think it's about culture, collaboration, and co-ownership. And co-ownership is a big piece that crypto and Web3 has that other technologies does not allow. And so that's a great way to look at that. And but with that, happy to chat more about this offline. But thank you again. It was so great to
Thank you.
Thanks.
chat.